Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On September 24th, Fidelity Investments Canada hosted Focus 2024 Montreal, a bilingual event connecting our portfolio managers directly with advisors. For French podcasts from the event, please keep an eye on our DialoguesFidelity podcast. Those will be released soon. Today, we'll listen in on our Global Asset Allocation Team session from the event, where portfolio managers David Wolf, David Tulk, and institutional portfolio manager Ilan Kolet sits down with Charles Danis, VP Regional Sales, Eastern Canada. The Global Asset Allocation Team manages several funds on behalf of Canadian investors, and we'll hear an update on their current positioning and market sentiment, including what is exciting them currently, what's keeping them up at night, how markets have moved this year, and where markets, inflation, interest rates, and more could go next. This podcast was recorded on September 24th, 2024.
Okay, bon, bienvenue. Ilan, let's kick it off with you. FMPs, 10 years in the making, 5 stars all over the place, phenomenal returns. What's the magic sauce? Why is this a family of products that has been working so very well?
Yeah, I think that's a great place to start. I mean, before we get into that, again, as you mentioned, it's wonderful to be here in Montreal. Thank you very much, everyone, for the support and for coming. We all spent time at the Bank of Canada, and a funny, very, very quick note is, I used to work on the recruiting side for the Bank of Canada, trying to get people to join the bank in Ottawa. And one of the things we used to joke is, the best thing about working at the Bank of Canada in Ottawa is it's only 2 hours from Montreal, right? So it's lovely to be here. But that's I think a really great place for us to start. So I think the reason that these funds have been so successful is really the ingredients, right? And by the ingredients, what I mean is our job is to manage the multi-asset class funds for Canadian investors, the fund of funds. And really there are 2 ingredients into that. The first is we reach across Fidelity in Canada, in the US, internationally, to pick managers, right, of different asset classes, of different styles and sectors. We choose the managers, so we choose that team, and combine them in such a way to really create, balanced exposures. We want them to do what's best, right? So there's that full division of labor. And then the second element is us using our very, very intensive research-based asset allocation framework, right? That has 4 pillars, which we'll talk about a little bit later, to lean in or out of asset classes, geographies, style sectors, and currencies, right? And so that's the combination. Those are the 2 things that together result, I think, in meaningful excess return. The chart that we're looking at here shows the global balance portfolio just over 10 years. Your actual experience in the global balance portfolio is the light green line or teal line or whatever that color is, versus a 60-40 portfolio, which is the blue line. And the wedge at the end of that, just over 10 years, is nearly 40%, right? That's a large and significant gap, where some of that is coming from fantastic underlying managers, many of whom you'll hear from today, right? Doing what they do best, and us including them in our mandates. And then us, again, leaning in or out of asset classes based on our research-based process, to add an additional chunk of return. So the thing to note here, though, is, this approach may not work every day or month or quarter, but what this slide shows is combining those 2 things in a very deliberate manner has resulted in pretty significant excess return over the long term.
If you don't mind me asking just a follow-up question on that, there's many of our competitors probably don't pick the portfolio managers the same ways you guys do. Can you give us a bit of a sense? I don't know who wants to pick this one up, but how do you pick the players within a portfolio? You've got full flexibility, right? You're not obliged to take somebody that's not doing well, that's not getting any funds in the retail. No, you can do whatever you want.
Yeah, we can do whatever we want. So maybe a couple of points to make on that. First, you mentioned in your intro about how we're all Fidelity employees. We all work very closely together. So we know these managers and we've known them. I've been working with them, others for over a decade. So we know and work with Patrice and Max and Hugo and Dan and dozens of other portfolio managers around the world. So we know them, they know their style, we know what they're thinking, and that helps us to be able to shape and size how much we want of each manager within the given funds. And then the other point I'll make is our incentives are structured in such a way that we very much want to pick the best managers. And to your point, we don't get forced to use one manager or the other, because the way that we get paid in running the multi-asset funds is on performance and only on performance. And that includes what we're doing as asset allocators, but it includes the performance that's being generated by the underlying managers. So if they don't do well, we don't do well, the investor doesn't do well, we don't like that. So we have full scope to choose the managers that we think are going to make the best contribution to the fund holder experience, full stop.
So everybody's aligned.
Everybody's aligned. And we'll talk a little bit about, everybody's going to perform differently, and that's fine. We actually want that diversification in the funds, but we want to make sure that managers are not only performing strongly and we have confidence in their process, they're also doing what we ask them to do. Because one thing that we need to have as multi-asset managers is, if you say you're a US growth manager, you can't be buying small cap EFI value, right? Everything has to be in its lane to make sure that the whole is operating the way it's supposed to be.
And just a side note, these are F-series returns, and we don't double dip. So the asset allocation products are not more expensive than an equity product or something like that. It's all inclusive.
Yeah, that's all net.
Yeah. Well, while you've got the stage, the S&P's been pretty good, up 20-ish. Bonds are kind of back. Like, what's your state of mind or the evolution of the market now, September 2024?
Sure. So we're pretty constructive. And as folks that have known us for a while know, that's not always the case. We're sort of naturally fairly prudent folks, but as you and I talked about on this, well, not this stage, Quebec City stage a year ago, and is true now, we think it's a reasonably good environment to be taking equity risk. So let me talk about it in the context of, Ilan mentioned the 4-pillar asset allocation process that we employ. So the first pillar is the macro, and that's nearest and dearest to our hearts as former central bankers and economists. I think the macro environment is pretty good, and that may surprise some folks. What you see from the sell-side research and the papers is generally pretty negative. And yes, growth has slowed, the unemployment rate has gone up, et cetera. And in the US in particular, I think that concern is overblown. I think that there's something underlyingly going on in the US economy that's very positive, and it has to do with faster growth in the economy's capacity. So that's productivity growth, that's labor force growth, and what it means is you can reaccelerate the economy without rekindling inflation. And the Fed knows this very well. They spend a lot more time thinking about capacity than anyone else, and we've seen that from the inside. And I think that's the best way to understand the 50 basis point cut last week. A lot of folks were like, oh, they must be panicking, they're concerned, they know something that we don't. I think that's the wrong way to look at it. I think it was actually reflective of a confidence that inflation is sufficiently under control, that they can push the economy as hard as they want without risking a return of inflation because of that capacity expansion. So I think that was a really good sign. Yes, things are slower, but the Fed is free to do whatever it needs to do to push things back up. Second pillar is what we call the bottom up, which is all of the intelligence that we're getting from our underlying PMs and analysts that we talked about. And there are dozens of these, and it's a global scope, as you mentioned. And I think it's a real source of edge because they're talking to the companies, they're seeing what's happening in the markets on the ground, they're feeding that information to us, and vice versa. I'm looking at Patrice in the audience, but it happens with all of the managers that we work with. And so what we do is we test our top-down view of the macro against the bottom-up information that we're getting from our analysts and PMs. And right now it's pretty good. It's not evenly so, by industry or by consumer segment or what have you, but at least in the US, we're not seeing any of the signs that you would ordinarily associate with an oncoming recession in terms of companies saying they're battening down the hatches, they're about to fire a bunch of people, et cetera. The third pillar is valuation. Tends not to be influential over the short term, but very influential over the long term. There is no question that valuations in the US are elevated relative to history. Most of that, though, is what they call the Magnificent Seven. So basically, the top of the market has valuations that, relative to others are pretty eye-watering. One of the things we do pretty much every week is we test with our analysts and PMs, do these valuations, can they be justified in the context of longer-term expectations for earnings growth? And the answer that generally comes back is yes. And so long as that's true, and they know more about this than we do, we're going to be able to keep embracing the market and thinking that these valuations aren't a barrier to stuff rallying. And then the final element is sentiment, and that pillar is really contrarian. So when everybody gets all bulled up, we want to be more cautious and vice versa. I think sentiment is fairly balanced at this point. It was maybe a little more bullish earlier in the summer, but we had the market volatility in August. We had it again in September earlier this month. And again, when I see these headlines that are, recession, not recession, that sort of seem quite bearish and miss the fact that we're now getting the response to a slowing economy that can reaccelerate things, that leaves us in a position where, all told, we're okay taking some equity risk. So that was a long way of saying we're relatively constructive.
Excellent. DT, the interest rates have started to come down in the last few months or last few weeks, but it seems that there's a different pace, or there might be a divergence between what's going on in Canada and the United States. Do you mind just talking us through of what that may cause?
Sure. No, I'm happy to unpack that, but maybe I'll just make a broad comment on our duration positioning more generally. As DW outlined, we're somewhat constructive on the outlook, and taking that equity risk means that we have to fund that from the bond portion of the portfolio. And within the bond portion of the portfolio, we've been pretty consistent in remaining neutral to slightly underweight duration. And the reason for that is I think markets are getting a little bit ahead of themselves in expecting a lot of easing from central banks. And yes, central banks have started that process, but I think, and we've seen this periodically in times past, where the market might be overreacting. And that expectation has allowed longer term yields also to fall to a certain extent, which makes me think that even if you get a moderate amount of central bank easing, you may not see the rest of the yield curve really respond with yields falling. And as a result, that makes us, again, very hesitant to embrace a lot of duration in a multi-asset portfolio. So unless you think that the market is headed for a recession or a hard landing, that would be the motivation to take a larger duration position in a balanced fund context. And because we don't think that, we're instead using that underweight to duration and underweight to bonds more generally to fund some of that equity overweight that DW mentioned, but also to fund a range of credit and other plus sector exposures, because we think that those can be economically sensitive. They can continue to perform well. And those are also managed using active managers who have the ability to use the research platform that we've spoken of to really bring a lot of security selection into our portfolio. So that will further enhance the yield portion of the fixed income portfolio. So that's the broad comment I would say on the bond side of the portfolio. But I also want to answer your question directly in terms of the pace of monetary easing from the Bank of Canada in comparison to the Federal Reserve. And there is definitely a difference. They've started together, but I think their endpoint is going to be somewhat different. So as DW mentioned, the 50 basis point cut is a reflection of confidence, I think, in their ability to bring inflation down. I'm somewhat sympathetic from their perspective of maybe waiting a little bit longer because they had been very much concerned about inflation. So they wanted to wait just an extra meeting for an extra couple of reports or two, just to be absolutely assured that inflation is coming down as they would expect, and then they can play a little bit of catch up. it's not a sense of panic by any degree that they're behind the curve. It's really a recalibration of policy, which is exactly the word that Chair Powell used numerous times in his press conference to follow. So I would imagine that because the US does have that higher rate of potential growth supported by an improvement in productivity and a number of other factors, that means that their resting point is likely to be higher than what it would be certainly in the Bank of Canada's case. And that allows for a shallower rate cutting cycle out of the Fed. So basically, the Bank of Canada faces some much more considerable challenges, certainly than the Fed. So expecting the Bank of Canada to cut a lot more than the Fed is more or less in the price of the market, but it's something that I think we would definitely expect to happen. And that would allow, I think, a certain amount of concern for the Canadian economy, because as I mentioned, the bond market has priced in a lot of easing. So if the Bank of Canada does continue to cut and you don't see 5-year yields or 10-year yields really rally in response, that just adds an additional source of stress, I think, to Canada's housing market and the consumer more generally. So at the end of the day, I think you could certainly see the spread between the Bank of Canada and the Federal Reserve opening up to a significant degree. And we've seen examples of that in the past, and that certainly, I think, has some interesting investment themes, particularly related to the currency that I think Ilan's going to speak to.
Why don't we go there? So the end game is different for both banks, probably not going to end up at the same levels. What does that do to the Canadian dollar?
Yeah, sure. I mean, that's a really, really interesting question. There's a bunch of different ways to attack it, I think. And what we've heard from DW and DT is, the U.S. is in the midst of this, productivity expansion, right? So the neutral rate of interest is that's that landing point. That's the nerdy way of saying the eventual landing point is higher, right? Whereas in Canada, Canada, we believe, is vulnerable to higher rates, right? So the way to think about this, I think, is the U.S. wants to cut rates. Canada has to cut rates, right? So there's an important nuance there. In Canada, way too much of the growth in the last 10, probably 20 years has been housing and consumer spending related to that housing, right? And so we've sort of gone drunk on one part of the economy. There's definitely a better way to say that, but you understand what I mean. And that has led to a really significant imbalance in the Canadian economy. It's time for another part of the Canadian economy to do some of the heavy lifting. And really, when this relative weakness appears, and to be quite honest, our research team actually believes in 2023 Canada was in a recession. It's possible in 2025 when Statistics Canada revises that data, they tell us that. Statistics Canada is very good at forecasting the past. But as investors, we don't have that luxury. And so when an economy like Canada enters this sort of stressful scenario, you kind of have three ways out to bring back that rebalancing. You can have an acceleration in foreign demand, right? We don't really think that's happening. That's not the base case. The second one is an acceleration or an increase in productivity growth. It took me a while. It took me a second to get to it because we haven't had productivity growth in 30 years. And the third one is, you guessed it, Canada goes on sale, right? So we get a depreciation of the Canadian dollar, which is our base case, which is our expected direction of travel for the Canadian dollar. And then the goods and the services that are purchased from Canada, right? So goods, think, lumber or the suits that are made in Montreal or used to be made, I guess. And the services, think of the movie filmed in the old port. Those get cheaper for the external firms buying that stuff. And that brings back some balance through kind of a natural mechanism. So that's sort of the way to think about it, and why we believe the direction of travel for the Canadian dollar is lower.
You talked about productivity expansion in the United States. DW, you've been talking about productivity for a number of years, although it kind of feels like it's just hitting the headlines this last year in Canada, and it may be an issue. Where do you think we stand as we speak about productivity?
Right, so I think it's, as we sort of alluded to, there's a rather different story in Canada versus in the US. So First, just to level set on productivity, it's an important economic concept. It's not necessarily a well understood concept more broadly by the public. So I think we have an intuitive sense of it. It's how efficiently you do things. And in some ways, it can be very concrete, like you have an auto plant, used to produce 3,000 cars a day, now produces 4,000 cars a day. That's higher productivity. But it's a lot broader than that for the economy as a whole. It's basically about efficiency, so having the right people in the right jobs with the right education and skills, the right capital to work with in the right places. And this is basically the determinant of living standards over time. It's the determinant of how big your economy can sustainably be without generating inflation. The story in the US has been a very good one on this front. So productivity growth has been running around 3% in the United States over the last couple of years. That's up from usually the run rate is around 1% or so. We do things better, but not very quickly as a society. So that 3% is very, very strong historically. And I think it's understandable given some of the underlying dynamics in the US economy. So number one, you've had some pretty aggressive investment in capacity. So that's things like manufacturing. So manufacturing fixed investment in the US is up 108% over the last couple of years. That's private, so that's not including all of the infrastructure that's going in with the Inflation Reduction Act. So that's a massive increase in capacity in the capital available to grow the economy. The second is AI, and nobody really knows what that's done, and maybe the gains, if they do come, are in the future. But that has to be some degree of a positive in terms of making things more efficient. And then arguably the biggest one, in my view, and my colleagues are probably tired of me talking about this for years now, is the pandemic blew up an antiquated 9-to-5, Monday to Friday, that's how people work type of paradigm, which was fine if you worked in a factory in the 1920s. It doesn't really make sense for many workers, including all of us in the room. So the greater flexibility that has come with being able to work from home, work from anywhere, what have you, has really improved our ability to be productive. Now, not everybody is going to be more productive, and when I say this to our old Bank of Canada colleagues, they say that there's no way, actually, we need to get them back in the office. But generally speaking, for the economy as a whole, it helps with flexibility, it helps with efficiency, and it's been helping with the labor market too. We've seen big increases in labor force participation in the US from women with children and disabled folks, like massive increases. And these are obviously folks who would have the hardest time with a standard schedule, that the ability to work from home or work from anywhere has been really important. So that's all really good stuff happening in the US. And as we talked about earlier, having that kind of productivity surge lets the economy grow and doesn't put pressure on inflation, which is why we can be optimistic that the Fed can be as aggressive as it needs to be in bouncing the economy. The story in Canada is pretty different. As Ilan alluded to, productivity has been a problem in Canada for decades. The gap to the US has actually been getting much wider in recent years. So I mentioned the 3% productivity growth in the US. In Canada, the number is about -1% to -2% over the past. So it's actually getting worse. Why is it getting worse? So people have been studying this for years and decades. It's not obvious exactly why. We do have a number of suspicions. So number one, Canada is, should we say, the industry is more concentrated. So we have 2 telcos and 3 grocers and 6 banks. It's just not as competitive an environment. We have a bigger public sector, and public sector is naturally less productive. So that's part of it.
Is that so?
I'm not going to touch that one. But the biggest reason is we just don't invest enough, particularly in high technology stuff. So one piece of data, if you will, in the US, investment in what they call intellectual property products, so this is research and development, software, et cetera, is about 6% of GDP. In Canada, it's about 3% of GDP, and that gap is widening. In Canada, it hasn't risen as a share of the economy for 20 years. And so we just don't put enough in. One of the reasons I think for that is actually the housing boom. So if you think about in Canada, the way to make a lot of money reliably over the last 30 years is by real estate. And it's been less reliable investing in businesses. So the money goes into real estate, which is fine, but that's an unproductive asset that doesn't add to the economy's capacity over time. So anyway, all to say that the productivity story in the US is very good. The productivity story in Canada, regrettably, is not. And that gets to all of the things that we've been talking about in terms of a difference in economic growth, a difference in neutral interest rates, and ultimately it's the kind of macro environment where Canadian assets, so Canadian dollar, Canadian equities, bond yields on offer in Canada are not likely to be as strong as in the US, and we're positioned that way.
Thanks for those comments. Mr. Tulk, we talked about the US, we talked about Canada. What are your thoughts on the international sleeves before we get into what's in the portfolio?
Yes, I mean, with all due respect to Patrice, there is the rest of the world outside of Canada and the US that he'll have a chance to talk about. But I think, from our perspective, not surprising, and you probably have heard this numerous times from us in the past, but we've been underweight in Canada, seeing much better opportunities elsewhere in the world. And previously we had been much more focused, I think, on the US for many of the reasons that we've talked about collectively on stage thus far, as just a more dynamic economy. That's really where the corporate earnings have been. But that's come at a certain cost in terms of relative valuation. So there are parts of the US market that are borderline prohibitively expensive. And even if there are some positive fundamentals that can justify some of those valuations, valuation is part of our process. And we do think about areas that have more compelling valuations to invest in. So one of the evolutions in our positioning is to take a little bit out of the US to look at other areas around the world that have maybe a little bit better of a turning point from a macro perspective, or also just generally more compelling valuations. So that includes a little bit into the EFI basket as well as into emerging markets. So if you believe in the broadening trade, if you believe in the soft landing story, then it stands to reason that other parts of the market that might have been neglected to a certain extent can play a little bit of a catch-up. So that's part of the motivation for having a more even allocation funded from an underweight in Canada to both the US as well as EFI and as well as EM. And that's the motivation from a valuation perspective, from a macro perspective as well. One of the things that we like to look at is where are estimates of earnings being revised higher? So where is there a sense that we can get incremental growth? And that has long been driven by the US, but we're seeing in recent months and recent quarters that that's beginning to spread a little bit. So you're getting a little bit more of a positive inflection in expected earnings coming from international, coming from Europe, coming from emerging markets to some degree as well. And so that's a macro signal to us that you might just see a little bit, again, not to take away anything from the US and its powerhouse status, but on the margin, a little bit better optimism out of some of those regions from an economic growth perspective. So that also does advocate to a certain degree from having a bit more of an even balance across those regional equity allocations. And then finally, from a sentiment perspective, sentiment, as DW mentioned, is a contrarian indicator for us. And a lot of these markets have been more or less left for dead as investors have really wanted to buy the tech rally, focus on the Magnificent Six or Seven, or however you want to define it, and really look away from some of these areas that I think, again, on a macro perspective, could be getting a little bit better. And within emerging markets specifically, we talked a lot about China, and China has some very significant structural headwinds. It's an area that you want to use an active manager in because there are parts of the Chinese story in particular that might be compelling from a security to security perspective. So using an active manager there has some appeal. Also, there's the cyclical element, which China has really struggled a lot to kind of provide a cyclical tailwind into their economy. But just this morning, they pulled out the proverbial bazooka to try to bring more stimulus into the economy. And it's probably too soon to tell if this has any lasting power. But again, if you're looking for opportunity on the margin, that part of the market is seeing a little bit more stimulus in contrast to many other parts of the economy that are still a little bit tighter. And that, I think, is compelling. And so at the end of the day, just to bring it all back to how we're positioned, We still have the underweight to Canada based on those concerns that we've spoken of, but on the margin, a little bit better balance between a US overweight, an EFI overweight, and an EM overweight.
So Ilan, can you walk us through the positioning of the product? This is like the ultimate global portfolio. It's probably a one-ticket solution. People could buy that and just leave it alone since there's asset allocation overlay, great portfolio managers within. But walk us through where you're putting more emphasis these days on the asset allocation.
Yeah, sure. So we'll just jump into this slide. And Charles, like you mentioned, I think the interesting thing with these portfolios is they're really elegant solutions to complex problems, right? So if you think about the breadth of the discussion that we've just had, right? Everything that we've talked about is encapsulated in this portfolio. So what we're looking at here, I realize you don't see, the folks in this room don't see this slide 300 times a year like we do. What we're looking at is the Global Balanced Managed Portfolio. This is a 60-40 portfolio of stocks and bonds. The 60 and the 40 are comprised of what's in that tiny writing in the bottom. The slide that we're looking at is the positioning, the asset allocation positioning that sits on top of that fund, right? So, right now, this fund is kind of a 64-36 is the way to think about it. So as we've discussed, sort of moderately or modestly overweight and tilted into equities sourced from the bond side. And just at a high level, and my colleagues will have some comments as well here, just to summarize kind of what we've discussed is we're cautious on Canada. So we shave off some of the Canadian equity side, that's that minus 4.5%, and allocate it to other parts of the world. There are two really important clarifying points on the underweight to Canada that I always like to mention. Sometimes when we talk about our cautious view on Canada and this kind of lagging economy and the positioning, people think we're rooting for some sort of Canadian implosion and we don't own any Canadian equities. And both are incorrect, right? So 21% of this portfolio are Canadian equities. We're shaving that by 4.5% and allocating it to asset classes or parts of the world that we think will win the race versus Canada. And the second point is the Canadian equity sleeve of this portfolio and its cousins have fantastic underlying managers that we're going to hear from today. If those underlying managers do well and beat their benchmarks, as they absolutely have, and they're in our funds, we win as well, right? So that's an important point. Again, optimistic on the U.S., a little bit lower than in the past, with a more evenly spread out positioning across the world. The commodity producer overweight, the thing to mention there is, really, I like to think about this as a function of two things. I don't know who's going to win the November election. I don't even want to try to answer that question. But the U.S. is not becoming any less protectionist, right? Under one scenario, it's probably more tariffs. Under the other, it's something that looks like protectionism that might be called industrial policy. That's inflationary. Commodities are a good insurance against that. So that's sort of one of the motivations there. And fiscal spending in the U.S. on top of a tight economy is inflationary as well. On the bond side of the picture, DT covered that quite well. Again, underweights to investment grade and overweights to those credit and spread sectors. An allocation, a fairly new allocation to alternative investments, which DW will talk about. And then, what I mentioned earlier is the direction of travel for the Canadian dollar, we believe, is lower. And we're underweight the Canadian dollar in our funds. If we're underweight the Canadian dollar, that's one way for us to build in sort of a shock absorber or a risk management tool in our portfolios. If the Canadian dollar depreciates, as we expect it to, and we are underweight the Canadian dollar, we preserve basis points, right? That's sort of how to think about that. I know we're coming up on time, so let me pass it back to you, Charles.
Well, actually, DW, alternatives, that might be a good segue. I think you got some new tools in the last few months in the PIPs and in the FMPs of what you can add. I think that it's the first time I'm on stage that I see a 2% attribution to alternatives.
Yeah, it's the first time you would have seen that, and folks would have seen that. There's a slight lag in the reporting in terms of disclosure, but earlier this year we did invest in liquid alternatives and also private real estate in a number of our private investment pools. First, let's level set for everyone on alternatives. They are what they sound like they are, which is just alternatives to traditional stocks and bonds. There are a bunch of different strategies. There's liquid alternatives, which is basically anything, but usually involves leverage, derivatives, long, short, relative value, et cetera. And then less liquid alternatives, which are mostly your private asset classes. So real estate, private credit, private equity, venture capital, et cetera. These have been very popular. I know a lot of folks have been, competitors have been coming out with these, including in multi-asset class funds. We get a lot of questions from advisors in terms of our inclusion. We've been very deliberate about the inclusion, and we're always suspicious when there's kind of a hot new thing. Maybe as an illustration, like I said, an alternative can be almost anything. So I'll paraphrase one of my favorite movies, and bonus points if anybody gets what movie this is from, is, you can take a bunch of garbage, put it in a box, mark it alternative, and all you got is an alternative piece of garbage, right? We're not gonna do that for its own sake. What we're gonna do is say, back to the diversification point, we are only gonna put something into our funds if we think it's gonna enhance return, improve diversification, or both. And we finally got to the stage with some of the internal products where we're comfortable in doing that, and so deployed 3 liquid alternative strategies in the FMPs. That's Global Value Long Short with Dan Dupont, who I know is speaking later, Long Short Alternative with Dave Way, and the Market Neutral Alternative with Brett DeLay. And let me use the example of Dan's fund to show how we thought about this. So all of you, I think, know Dan, great manager, very value-oriented, defensive-focused, et cetera. He really Global Value Long Short is really a concentrated version of that, which means it can be quite volatile, and folks involved have seen that, which makes it a little bit challenging if you want to own it by itself. But it's fantastic if you're an asset allocator to own it with a bunch of other stuff. Because Dan, because he's so defensive, tends to move in the opposite direction as equities, which are most of the risk in a fund. So we have someone who we think is going to outperform over time, but is also going to hedge us in the meantime, because he's going to tend to go up when stocks go down. And that's helpful in terms of risk-adjusted returns in the funds. So that's on the FMPs and liquid alternatives. The other thing I'll mention, and I know we're close to time, is we've employed a Brookfield-managed, exclusive to Fidelity, I believe, private real estate capability within the private investment pools. And here, again, the principle is it's an alternative source of return versus what you get in stocks and bonds. It's one that pension funds have been using for years. It's harder in a daily liquidity fund like we manage, but we've managed to figure out a
So we actually buy the bricks.
We buy the bricks. Okay. We bought a bunch of bricks. But we've been very slow about it. And again, I'll say deliberate, because if you go back a couple of years ago, when we first started working with Brookfield on this, Canadian commercial real estate elsewhere, was under a lot of pressure, right? You had valuations were too high, interest rates going up, et cetera. We were in no hurry to deploy capital. Now, with valuations having adjusted, with opportunities coming up, and the fresh capital that we have available, because we're unencumbered by legacy assets, what it means is we're able to be opportunistic in getting money put to work. So we started that process in May. It's been going pretty well so far. And again, it's an alternative investment that we have in the funds because, and only because, we think it's going to help with risk-adjusted return.
Super. Gentlemen, thank you very much for your partnership, and congratulations on phenomenal returns. Thank you.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.